Robert, I'm going to have you break it down a bit here because as we've been watching the market, it's a strong reaction initially. We have seen this come off of session lows in terms of the majors. We've seen yields, sort of spike and sort of pull back just a bit. To what extent does this print we got today strengthen the case for another rate hike this year?
Thanks so much for having me. And that's a great question. I think going into this week, the Fed was looking at a labor market that seemed to be moderating materially. The quits rate had normalized back to pre-COVID levels. Job openings were coming down. Job growth was moderating. And a lot of those factors got thrown in the other direction. You saw job openings surge in the latest print. And of course, this blockbuster jobs number that you saw in the payrolls report today. So I think on balance, it puts the Fed in a difficult spot because on the one hand, they're seeing very strong labor demand and very strong hiring, probably at an unsustainable pace. On the other hand, you also saw wage growth come in a bit softer than expected. I think for Fed officials, they'll look at these numbers and mostly focus on the job figures and say, well, at these levels, wage growth has upside risk and is probably going to move up from here. So I think it strengthens the case for another hike, but it doesn't guarantee it given that you're getting some mixed signals on the wage side. And you've had this big rise in long-term yields that is doing some of the work for the Fed. So I think the next meeting in November is going to be a close one, but on balance, this strengthens the case for another hike.
But you have to wonder then, how did analysts get this so wrong? Is it about seasonality or is there something else at play here? Because, this was a huge difference between the expectations here and what we got for September's numbers.
Yeah, it's a great question. And I think some of it's going to be seasonality. Always have in some of these reports, you always have very difficult issues in adjusting for certain seasonal factors, such as when the school year starts and various education-related hiring. But on balance, I think what people have been looking for is the Fed has hiked rates a lot so far in this cycle. People are expecting that to play through with a lag. And you've seen some of the indicators of activity soften, but the labor market still refuses to slow down. I think a great example is within the goods sector. We know goods demand has been very weak globally. Surveys of manufacturing have been soft, and yet the manufacturing sector keeps adding jobs. And so I think you're seeing a lot of mixed signals within the indicators, and that expectation that things are going to slow down because the Fed's done a lot of work hasn't just really been playing out as people expected.